Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so this is a real estate market update for Las Vegas for December 2022. This is only for Las Vegas. Okay, now you can infer what you want about the rest of the market based on this. That we're not talking about the national real estate market. We're just talking about what's happening in Las Vegas. We've been doing these every 2 weeks because the market's been changing. It hasn't been like a normal stable market. And even when the market was going up, we were doing it every month because it was going up more predictably, right?
Right. So the idea behind doing it every couple of weeks rather than just once a month is because the market has been on the decline, and that gives people concern, or at the very least pause.
Yeah.
And so we wanted to keep you updated. Remember, the real estate market is hyper-local, so not just because we're in Las Vegas, but even within Las Vegas, one neighborhood can have a completely different experience in this market than the adjoining neighborhood.
So we're going to go over data that's general for Las Vegas. And like Juan has said, we have seen the examples of like, oh, there was a new home builder who did this one thing and then everyone made a big deal about it. They dropped their price 20% or 10% or whatever. But we've got actual data we're going to go through that's pretty good. So we'll start with the first chart here, Market Action Index. It's the first one we always show. Now the Market Action Index is 32, and it's been bouncing between 32, 33, and 34 for like almost 3 months, which is still, you see it on there, it's a slight seller's advantage. It's still a slight seller's advantage, but to the average person, they would say no way, because what they're comparing it to is the last 2 years. Mm-hmm. So if you were born 2 years ago and you're buying a house today, you think this is like the worst market you've ever seen, and it is. And the last 2 years is the worst market. But if you were to have woken up, if you went to a coma in 2019 and said, oh my gosh, I can't wait to go buy a house because the market must have crashed by now. What are prices at? And then they told you what median price is at. You would have said, wait, what? Right? So it's based on, it's sort of, it's still kind of, people are still trying to get a handle on what's going on.
Right. I think most of us have gotten to the point now where we understand it's a more even-handed market. So buyers have choices, sellers need to be more understanding. And to that end, what we've seen is that inventory levels are leveling off or declining, right? Mm-hmm. And that prices are, for the most part, pretty stable. I mean, they certainly have declined since the froth at the beginning of the summer, but they haven't by any means crashed. They're still higher than where they started the year. Mm-hmm. And as far as days on the market, yes, they're getting longer. You know, we expected that, and it's all good. It's fine. Everybody's just kind of finding their footing.
Yeah. The next one we're going to talk about here is median list price. Now, the interesting thing about this is you can see the dashed line, which is the 7-day average. That's a leading indicator. If you look at and what this means is if you look at activity over 7 days, it is more important telling you what's going to happen in the future than if you look at the last 90 days, mm-hmm. right? Because 90 days is more historical, 7 days is more trending. And you can see that from the middle of the chart, which is basically the beginning of 2021 to just a few months ago, that little dashed line was above, which just meant the 7-day average was higher. So it was that prices were going higher. Mm-hmm. And this is median price, okay? And you can see it dropped back in the fall as interest rates went up, or in the spring as interest rates went up. And then that leading indicator was less. And you could see it was pretty far less. Mm-hmm. It showed a substantial decline. Well, what happened is a few months into this, we started to see that change. And then that's when a lot of the housing crasher people freaked out because they realized that it was turning around again. And if you look at this here, we actually grabbed the numbers so 489 to 495, that difference is only $6,000, that 7-day average. And it's very possible now that these numbers are coming together, they could go and diverge again. But if they switch over the next 2 months, what that means is higher prices in the spring.
Well, and we know that the government expects higher prices in the spring. And the reason we know that is because they came out and increase the amount of money that they'll loan on a conventional loan. Now, it is a market by market. In Las Vegas, it's about $736,000, I believe, something like that. So that number has increased. What that means to the rest of us is that so anything at that number or below can be a regular conventional loan, so you don't have to go jumbo. So that lets us know that because the government has increased the amount that they consider a conventional loan that then can be sold on the secondary market, that they are expecting prices to continue to increase. We also know that the Fed has said that they are going to not be as exuberant with their rate increases.
Yep.
So they're going to kind of take a more wait and see attitude, maybe just do quarter point increases and not be quite so enthusiastic about raising interest rates.
The other interesting thing to keep in mind is that this median list price that we just talked about, this is just list price. List price is a very subjective that changes dramatically in as markets change, because list price is a strategy for marketing. Mm-hmm. It's a part of marketing strategy. So, the list price you might have chosen 8 months ago is substantially different than the list price you would choose today.
Right. And remember, a list price is nothing more than what? An invitation to make an offer. It doesn't mean that you won't take more. It doesn't mean that you won't take less. It's just a place to start.
Right. Okay, the next thing we're going to go through is inventory. Now, this is the super critical one. If you watch every one of our videos for the last 2 years, every market update, every single one we talk about this. This is the most important number. Now, if you go all the way to the left side of this chart, that was the inventory back in basically the end of 2019. And you can see we never got back to that number. We actually never got back to 2019 inventory, which is another reason why the market crashers have they're not going to ever apologize and say they were wrong, but the inventory is starting to decline again. And if you look at the 7-day average versus the 90-day average, the 7-day average is 4,900, the 90-day average was 5,300. And then we've got another one we're going to show you after this that's even better, that shows this in better detail. The other thing is that leading edge, and you can see it turning down, that it's starting to decline again. And it's a natural process. There's more inventory in the fall because stuff takes longer to sell, and then there's less, even though there's more transactions in the spring, there's less inventory because stuff's on the market a shorter amount of time.
Right.
So what do you think, potentially this is kind of weird because you have this expectation where I hear people just say, well, real estate's going to really take a beating, and now I see inventory declining. So how do you reconcile those? Because this is real. These are real numbers. This isn't opinion. Oh, real estate's going to get beaten up now. And then I'm saying, yeah, but how's it going to get beaten up if there's less stuff on? How does that work? What's going on here?
Right. So look, it's supply and demand. So long as the supply is low and the demand is neither too high nor too low, then you're going to have a good equilibrium and you're going to have a pretty stable market. What's going to happen in the spring is everybody's going to want to come play, and you're going to have a lot more transactions happen. So that's part of the reason why the inventory is going to appear lower. There will actually be more inventory, but it will appear to be lower because things will get sold a little bit faster because buyers will come back. And we've talked about this before. Buyers will come back in the spring for a number of reasons. That they're thawing out, they're getting ready for the new school year, they're relocating, they're spending their tax refund, they maybe are tired of paying higher taxes and they're looking to a way to mitigate their taxes, whatever their reasons are. It's just a cyclical thing that happens in the spring.
The next thing is very, very, this is the most telling. Okay, so this is the actual number of inventory. Now remember, this is just for Las Vegas. These are just houses. So it's under 5,000 houses. Now,
right. So just a caveat, if you're not used to watching these videos with us, this is just Las Vegas, does not include Henderson, Boulder City, North Las Vegas, all the surrounding areas. So when
Boulder City,
right.
Everything.
So when you're watching videos put out by others, they are likely including the entire metro area, which is fine, but we always just focus on Las Vegas so that our numbers are comparable over the long run. and you get a better sense of what's happening in the market.
Okay, on October 21st, which was about 5 to 6 weeks ago, there were 5,700 houses on the market. There's 4,900, under 5,000. Now, the trend is that will decrease. That's what happens every year. We will keep doing videos every 2 weeks to watch this number. But with this number going down, I'm not saying home prices will go up, but it definitely hinders the potential for a rapid decline in home prices. In 2005, when we were doing our radio show, home prices, inventory was still increasing. And it increased through to end of 2005 and all of 2006. And it was pretty dicey there. I mean, there was tons of houses on the market. We got up to 26,000. Now remember, that was the whole MLS. But for Vegas, that would have been 15,000. And then that's 15,000 compared to less than 5,000 today. So it's less than a third. Plus, remember, Vegas was a smaller town by about 40% back then. Like, we're a lot bigger now because we've grown and we've added more houses over the last almost 20 years now since that happened, 16 years ago, right? Since 2005, 2006. So we would have to have the same impact as what we had back then. Because I see these videos and blogs, oh, this will be worse than 2006, and it's clickbait. Because if you go on those, if you read the ads, then they're serving up, or if you read the article, they're serving up ads, and they get money for every time. So they're trying to get you to click on the ad, right? That's where clickbait comes from. So you would have to have probably over 20,000 or 25,000 just in Vegas, not the whole MLS. And we have less than 5,000, and it's declining.
Right.
So, yeah.
Well, what I was going to say is part of the reason why it's declining is, remember, two reasons. We've talked about this repeatedly recently. The inventory is declining for a number of reasons. Number one, properties are selling. Number two, new properties are not coming to market because of the time of year. And number three, homes that haven't sold are being taken off the market over the holidays. So those are some of the reasons why inventory is declining. And of course, like I said, people are buying homes, so it's not like we're not selling any homes, because we are. So those are the reasons why inventory is declining. So it's not just a one-sided thing. It is a multifaceted situation as to why inventory is decreasing this time of year.
Yeah. Remember this from the other videos we've done. People don't have to sell. If you go back to the last time we had a housing crisis, there were people with much higher interest rates that were A, upside down, but then B, the house payment was way more than they would have ever paid to rent the same house. So you couldn't, as an investor, it didn't make sense from a money standpoint. And then from a homeowner, it didn't make sense because you were only betting on the price going up. And that's the difference now is it's flipped upside down. No one's betting on the price to go up. You don't care if prices go up or down because your payment's $1,200, and if you wanted to rent the house, you could get $2,000 for it. So that's something that didn't exist back then.
Right.
Okay, next one is average days on the market. This, as you can see here, it increases every year until probably January, February. The average days on the market increases. This does lag a little. The indicator for this lags a little because it's based on closing. It's based on after it closes. So what's interesting, though, is if you look back to 2020 and 2020 last year, because this will go into 2023, 2021, 2022, that little dashed line was above the solid line, the 7-day indicator, but you can see that it made a sharp turn. It makes a sharp turn basically around January, which is when it starts to pick up. So we'll watch this, but here's the interesting thing, is we're still well below the average days on the market for even 2021, which was the hottest market we've ever seen. Average days on the market still hasn't gotten back. We're approaching it, but we still have less days on the market, which is, for us, it's not intuitive. This should be higher based on all the data we've seen, but this is telling us that this is just one data point saying this is going to probably turn pretty quick in the spring.
That's very likely, particularly with interest rates kind of finding their happy point and not continuing to rise sharply, with conventional loans having a higher limit. So there are lots of things at play.
Well, we've said this before. Every time historically that rates have gone up, it was an 18-month thing before they came down. And we're about 10 months through this now. Mm-hmm. We're more than halfway through, it seems like.
Right.
So, and then the other thing we said back in September that October, November, December, January, those 4 months would be a good time to buy a house. Mm-hmm. We thought that was like a sweet spot for this time of year. Clearly, if you'd bought a house in 2020 or 2019 or 2018 or 2017 or any year past back then, you've done very well. Mm-hmm. Not only because of the interest rate, because the price of the house. And but I won't say that it's a good time. It would be a great time to buy if you wait till February, March, April, May. I don't know that that's going to be a good time, because based on what we've seen, it's probably going to get competitive again. And if it gets competitive, it's going to be good for Juana and I, because we work with sellers, we do listings, and it's very good for us to represent and the seller, to help that seller out in a time when we have more options, more negotiating tactics, and tools we can use to get the seller more money, get the buyer to pay a higher price.
Right. And, but this works, even if you're looking to purchase now. I mean, as a seller, we've talked about this before. You have tools in your toolbox now. You can help the buyer out by paying to lower their interest rate, by helping them with closing costs, doing things that help the buyer out and help them get your transaction closed. So you always have tools in your toolbox.
Okay, this is the next one here. This is the price per square foot. This is a closed price per square foot. This also lags a little bit. You can see this is very, very, because this is price, this is not as volatile. This is the least volatile chart we've shown yet. You could see that the first third of that chart from left to right, it was the leading indicator was slightly above the 90-day average, but then it went above it. And then last year, in 2022, as interest rates went up, that the leading indicator turned sharply. Mm-hmm. But what you've noticed is that if you look at that from top to bottom, the very tippy top, home prices are still more than they were in January. Mm-hmm. We're still up for January. We're going to finish the year over year up. So if you watched our video from 2 weeks ago, where we said home prices went up in 22, and you said, no, they're not. They're going down. Yes, they've gone down from the peaky peak, the top little peak, the frothy top of the market. But they're still up year over year. But what's interesting is only 8%. Mm-hmm. And then that little difference there is starting to narrow again. Mm-hmm. That's the really interesting thing, because remember, this is a leading indicator. So we think February, March, April, we start to get that market action index starts to take off again. The question is do we go back into complete craziness like we did last time, or we just go back to a normal market? Because if you took out the last 2 years and just completely took them out, and you sawed off 2020, 2021, 2022, and stuck this on to the end of 2019, it doesn't look any different. Mm-hmm. Statistically, other than the price, it doesn't look any different. It looks like the same market. The people in 2019 wouldn't know the difference. Right,
but we certainly have had uncommon events in the last few years that have caused a lot of behavioral changes in both buyers and sellers.
Okay.
Because it was an unprecedented situation, and I think that had a lot to do with what happened. It wasn't just the cyclical part of the market, but I think it was between the pandemic, between the politics, between the working remotely. There were just so many moving pieces that all played a role in what created the avalanche of buyers wanting to get into a house and sellers going, I'm going to take the last train out of Dodge and get as much money for the house that as I can.
Yeah, if you look at all those factors, they're on both sides of the equation, but most of them were on the buy a house side of the equation. And then interest rates sort of is the fuel for the fire that caused it to be more exuberant than 4.8%, which is what it on average is every year. We think the next couple years are going to be much less. The analysis that NAR did said 1% next year.
I would just call it calm.
Calm. It's going to chill out, and then they were of course their 2024 estimate was plus 10, or was it plus 10% or something? It was a bit crazy.
Right. So, I don't know about that. I think that even though 2024 is not that far away, I think that 2024 is going to bring a lot more uncertainty because we will have gone through the whole interest rate thing. The economy will be wherever it is. We're going to be in an election year, so there's going to be lots of interesting things that make people make decisions that they would not make in a different year.
Okay. Bottom line is this. We have two factors affecting real estate in Las Vegas. One are market forces. You can't argue with those. They're statistical. You can measure them. And Juan and I are very analytical. We've been doing this a long time, but we're very analytical. And then you have emotional, psychological factors. And they deal with people's experiences and what their experiences are with previous real estate transactions.
And perception. Never underestimate perception, because perception has nothing to do with reality. It has to do with emotion. As you know, we've all heard, numbers don't care about your feelings. Well, your feelings care about numbers.
Yeah, and your perception is what's going to drive your expectation. So the thing that we have noticed the most talking to sellers is that there are times their expectations are out of touch because they are based on the past that you can't go back to, and they're based on factors that are not rooted in anything other than, fantasy. It's like, we've seen this in the past, and this is not, I would say, years and years ago. The seller who had to get exactly 300. I actually had a seller once turn down it was this crappy house built in the 60s. It was a crappy house. It was on the east side of town. It was in a really terrible area. They had paid $115 for it. We had an offer for $295 or $298, but they had to get 300. They had to. There was a psychological thing. They had to get 300. And we turned down an offer, and then this was in 2005.
Oops.
Yeah, and we end up not selling the house. Yeah, they didn't. They got to a point where the market declined, and they changed their mind, and they turned down an offer that they could have sold the house. And I'm sure, no question, that at the bottom of the market, the house was worth under $100,000. They'd probably lost 2/3 of its value.
Okay, so if you list your house with us, I will not let Todd call your house a crappy house. Okay?
Yeah, no, it was they were pretty. This was going to be a win for them. This was going to be the biggest financial win of their life, and they couldn't get wrapped. They wanted to be able to say they got 300,000, and no matter what I could do, I couldn't get them to agree to sell the house for almost. They would have literally handed off the house to somebody at literally the peak of the market.
Well, that's the way it goes. Yeah. So if you liked the video, if you thought it was informative, interesting, entertaining, if you got something out of it, please like the video, share the video, subscribe, hit the notification bell. Tell us what you think. Tell us what you think about your market and where you are. So if you're telling us an anecdotal story or about a story specific about that's happening to you or that's happened to you, tell us what market that's in, because we are lucky enough to have an audience that is pretty far reaching, so we want to know where you are. If you're in Vegas, that's great. Tell us what's going on with you. If you're interested in selling your house, please consider using our services and give us a call. If you are interested in buying or selling anywhere in the country, please reach out to us. We have a network of great agents that we can connect you with. Please leave us lovely comments. Please be nice to each other in the comments, and we'll see you on the next video. Bye.
Bye.